it's Mike Lynch with the Lynch Mortgage Team, and it's time for your Monday morning mortgage update for the week of December the 12th. Hope everybody had a fantastic weekend. What a weather weekend we had. Tons of snow and rain Friday and Saturday. I think Mount Shasta got over 30 inches of snow. So much snow they couldn't even open up their new run. But that was all good because there was a bunch of avalanche risk up there. And then Sunday, amazing ski day on Sunday. Hope everybody got out and enjoyed the Blue Bird cold Sunday. So let's talk about the market. As always, I always try to give you some perspective on what's happening in the mortgage industry, how it affects our buyers and our sellers, rates, everything else. And I want to cut right to the chart, a chart I've shown you many times. And it basically is the chart that shows the trading of mortgage-backed securities in the bond market. We know that mortgage interest rates are determined by the trading of mortgage-backed securities in the bond market. And in this market, in this graph here, it's a live graph and it shows you going back to September 20th. And each one of these bars represents one day of trading. We call these candlesticks because you can see little wicks on here because it shows the highs and the low and where the trading ended and started in the day. When we see green, that means money's flowing into the bond market and mortgage rates are getting better. When we see the red, money's flowing out of the bond market and mortgage rates are getting worse. So we've seen since September 20th, a lot of volatility. I can take this back further. And again, just a ton of volatility as we've seen such a change in our market in the last 12 months. But I want to go back just about 30 days. And you can see the one big green bar here that sticks out. And that shows you the trading on November the 10th. And that was the last Federal Reserve meeting, which is starting tomorrow. So the Federal Reserve meets about every month or two, and they raise their Fed fund rate or the prime rate, or they lower it, or they leave it alone. They come out with their economic projections, policies, everything else. And when the Federal Reserve meets and raises or lowers that Fed fund rate, this is what's reported in the news. Everybody pays attention to this. And I want to give you some perspective. This green bar here was one of the largest improvements in the bond market that we've ever seen. And this followed the Federal Reserve's meeting November 10th, which basically showed with some reports that came out that inflation was starting to ease. It wasn't going down, it was just easing. It was starting to abate. And why is this happening? Because the Federal Reserve has been raising that Fed fund rate since March, 3/4 of a point, 3/4 of a point, 3/4 of a point, to fight inflation. And as the Fed does this, it creates higher cost for businesses to borrow money, which they pass on that increased cost to the consumer. Consumer buys less stuff, prices come down, inflation comes down, and inflation is kryptonite for mortgage rates. So as inflation comes down, interest rates, mortgage interest rates get better. So on November 10th, the Fed said, hey, this is some good news. We are starting to see that maybe what we've been doing, even though it's been painful for everybody, is working. And then we just rode this wave of really not much change to interest rates for the past 30 days. But the impactful thing here is that in the last 30 days, mortgage rates have improved about a percentage point. Prior to November 10th, they were over 7%. Now they're in the mid to low 6% range. And so this is a big improvement in a very short period of time. Now, as I said, the Federal Reserve's meeting this week. Is the same thing going to happen? That's the big question. What we can see is last week we saw the pricing get worse. And the week before that, the pricing got better. But it's all ending the same. There really hasn't been any improvement if we look at today compared to 2 weeks ago. So I always talk about three things in the market. What's going to affect the market this week? The three things are the Fed meeting, that's the big one. Inflation, that's always at the top of the list. And I want to talk about some reports that came out about equity in property. So let's talk about the Federal Reserve. They're meeting tomorrow. It's always a 2-day meeting. They start meeting tomorrow. And then after their meeting is over, Wednesday afternoon, they come out with their Fed minutes. And Jerome Powell, the Federal Reserve, has a press conference. So a lot of attention is going to be paid to what he says. And the important thing about this meeting, it's the last one of the year, is that they're projected to raise the Fed fund rate 0.5 point. That's different than they've been doing. So it's actually a reduction in what they've been doing. They've been raising the Fed fund rate for all the other meetings 0.75 point. And again, this is fighting inflation. the mistake that people make is that when they see this report, and our buyers and our sellers see this, is that when this is reported to the media that the Federal Reserve raised the Fed fund rate a half a point, that means mortgage rates go up a half a point. Couldn't be further from the truth. And if you look at what happened November 10th, go back to the graph here, you can see that the Federal Reserve raised their Fed fund rate 0.75%, and it actually improved mortgage rates because the bond traders, the bond market shows us as a confidence that the Federal Reserve is willing to make the tough choices to fight inflation, which ultimately is better for our economy and better for mortgage rates. So will the same thing happen at this meeting? Time will tell. We'll be paying a lot of attention to what happens at the end of the day, Wednesday, when the minutes come out, their decision comes out, and Jerome Powell has his press conference. And they're also going to talk about economic projections for 2023. Now, the last couple meetings, they've said, hey, we're going to raise rates to the end of the year, and then we're going to leave the Federal Reserve rate alone and let it bake, let it mature, let it ferment, and really drive our economy into some type of a recession, because that's how we can get inflation down. And we know in past recessions, when we go into a recession, mortgage rates typically get better because the Federal Reserve now starts to lower the Fed fund rate to fight recessionary problems. So it's this yin and yang, this up and down. It's the game that they play, but we'll be paying, again, a lot of attention to what happens Wednesday afternoon. The other thing is inflation. So tomorrow, the CPI report comes out, the Consumer Price Index. If we go back to November 10th here again, this was when the last CPI report came out, and look at what it did to the market. So what it showed on November 10th is that the inflation is starting to ease. It's not getting worse, it's starting to ease. Now, the estimates is that the inflationary number that's going to come out tomorrow will replace the old number a year ago, and it's supposed to decrease. That means inflation is supposed to be lower a year ago than it today or tomorrow than it was a year ago. This is good. This means that inflation is starting to ease, and so we'll be watching this. Now, will we see this huge improvement? Probably not. I wouldn't expect that we're going to see another massive improvement in the bond market, but we're going to start to see, the expectation is we're going to start to see mortgage rates trickle down over the coming months. With the expectation, Fannie Mae and some other entities have said that rates could be in the 5% range by summer. So a lot of stuff will be happening tomorrow. It's a very, very big day tomorrow. Also, there's a 30-year bond auction. The Federal Reserve, the government, sells bonds to raise money, and a 30-year bond auction basically is the same vehicle as a mortgage-backed security. And so if there's a lot of demand for that, that means money will flow into the bond market, and that also could improve rates. So again, tomorrow is a very pivotal day, a lot of volatility leading into tomorrow and Wednesday. And then the last thing is equity. So some equity reports came out, and I thought this was very interesting. 33% of homeowners own their homes free and clear right now. That's a big number. It's up. This is a strong indication that there's a ton of equity. And if we see a downturn in the market, we're going to be able to weather this storm. Equity generally is up 16% from a year ago. 16% from a year ago. So it's higher than it was a year ago. Negative equity is down to 1.9% from a year ago. It's down 1.9% from a year ago. And if we compare this to the last housing crisis, 2008, 9, and 10, in 2008, negative equity was at 28%. So we are so far off from the negative equity that most homeowners had back in 2008, 9, and 10. And that's just a very positive number. So we're looking at a lot of volatility this week, leading into tomorrow and Wednesday. We're carefully watching that market. We hope that we're going to get some positive news on pricing, maybe see a little bit of a bump in interest rates without the expectation that we're going to see the big bump we saw on November 10th. If you have any questions about rates, about products, please let me know. Forward this video to anybody you think could benefit from it. Have a great productive week, and we'll talk to you next week. Bye-bye.